We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Investing is a complex activity, but that doesn't mean it requires a complex solution. That's the opening sentence of Chapter 5, which is titled, Your Introduction to Investing. In this episode, I'm going to walk through the investing chapters of my book, Making Money Simple, the complete guide to getting your financial house in order and keeping it that way forever. And in the last episode, I went through the first 4 chapters of the book, which focuses on creating a system for financial success by making intentional, systematic choices with your money. And we saw how a good system will direct dollars to the things that matter most and keep you on track for reaching your end goals. We also discussed how a systematic process can reduce or eliminate our human tendencies that lead to poor consumption choices, as well as having subpar saving and investing decisions. Now, with a good saving system in place, we can turn our focus to investing. Successful investing allows you to maximize the impact of the good savings habits you would have implemented in the first 4 chapters by offering a higher compound rate of return. But how do you earn those higher compound rates of return? As the opening quote suggests, most people think the answer must be a complex one. However, the best way to invest is elegantly simple. You don't need to be an investment expert or work harder than everyone else to be a successful investor. I tell a story at the beginning of the chapter about Grace Groner to emphasize this point. Grace was back in the news in 2010 when at her death, she had left $7 million to a foundation benefiting Lake Forest College because she was a career secretary that had never shown really any signs of having that sort of wealth. And Grace's success was simple. She bought stock early in her career and never sold it. She didn't panic when the stock market was up or down or try to avoid periods of heightened volatility. She didn't make frequent changes to her portfolio in hopes of profiting from the current market trends. She didn't spend time trying to find the next Apple or Amazon of her day. She didn't move money back and forth between investment managers in hope of capturing the highest possible return. No, she simply reinvested the dividends from her initial investment and never sold. These simple actions allowed her to avoid the mistakes that plague most investors and fully benefit from decades of uninterrupted compound growth. Most people think they need to be like Warren Buffett to grow their wealth, but even Buffett credits his financial success to minimizing mistakes and allowing the magic of compounding to work for multiple decades. Here are a couple of the numbers I shared in the book. $80.7 billion of Buffett's $81 billion net worth was accumulated after his 50th birthday. And $78 billion of the $81 billion came after he qualified for Social Security in his mid-60s. So when you see thousands of articles and books written about Buffett, it's easy to overlook how powerful the impact of time and compound interest had been on his net worth. Here's a quote from the book I like. Quote, "Good investing isn't necessarily about earning the highest returns. It's about doing the same thing for decades on end." End quote. The problem for most investors is, unlike Warren Buffett and Grace Groner, they get in their own way. And I share some data in the book about why the average investor performs so poorly, but it basically boils down to poor behavior. When people follow their natural instincts, they apply faulty reasoning to investment decisions. Throughout our evolution as a species, we've developed all these cognitive shortcuts to evaluate evidence that requires a great deal of mental energy. So rather than think through a problem, particularly when it's complicated or unclear, our brains prefer to take shortcuts. These mental shortcuts are deeply ingrained into our DNA, which you may not realize remains very similar to the building blocks our species developed during the cognitive revolution 70,000 years ago. Now, consider that it wasn't until roughly 12,000 years ago that our species began trading in their hunting and gathering ways to live on cultivated land and farms. Now consider again that the scientific revolution began only 500 years ago, and that led to an explosion of innovation and advancement. So for most of human history, people have spent very little time with the type of data and inputs often associated with investing. And our decisions tend to be survival-based as a species. We carry those tendencies with us today. And unfortunately, survival-based logic usually results in poor investment behavior. In my role as Chief Investment Officer, I see this play out time and again. When the market goes down, our human fear instinct kicks in, and it makes us feel like we need to do something. When our ancient ancestors heard a rustle in the bushes, They ran out of fear. They didn't have time to calculate the probability that the noise in the bushes was a lion. If it was, taking the time to think about it posed way too much of a risk of getting pounded on. Better to get away first and evaluate later. But thankfully, most of us no longer need to worry about being hunted down by lions, but that instinct to react when we feel threatened remains. Markets, they go up, they go down. Logically, we can know that in advance, but emotionally, we have a hard time staying calm and reasonable when markets behave in a way that make us concerned about our wealth. On the other hand, we also have a hard time staying calm and reasonable when the market or any particular investment gets us excited about increasing our wealth. The point is that reacting to current market conditions, whether they're good or bad, leads to poor investment decisions. And in Chapter 5, I dive into some of these behavioral reasons that we tend to do silly things that ultimately leads to performance chasing or market timing. One of the things that interests me most about my profession is this psychology investing, and really the psychology around all financial decisions. So while I dive into a couple key concepts, it's by no means comprehensive. If you're looking for some good behavioral finance books, I'll share a link to my favorite books where I break out a section just on behavioral finance in the show notes. But to wrap up Chapter 5, there's a section on investment fees, and I think it can be summed up quite simply with just this one quote. Quote, "The less you pay, the more of a fund's return you keep." End quote. So moving into Chapter 6, which is titled Harnessing the Power of Markets, this may be my favorite chapter in the book because I'm able to share a pretty wide variety of narratives that distill complex investing topics into easily digestible lessons and make investing as a whole seem more approachable. So when people come to me for advice, they typically want to jump right into the how, but they skip the theory, skipping the why. And skipping the theory is like playing a board game without ever learning the rules. Learning the rules to the game gives you direction, which in turn makes you better equipped to deal with the inevitable adversity you face as an investor. And I can't emphasize enough how important this can be to staying the course, to being a long-term investor. The chapter leads off with a story about my father-in-law and the way he goes about buying cars that paints a really tangible picture of how markets work. And I have a related blog post that I can link to in the show notes, so I won't repeat that story here. But understanding how markets work is one of the most important things a long-term investor can understand. Markets are at work all around us. For example, when I go to the grocery store, I usually buy some kind of fruit depending on the prices. My favorite is raspberries, which, like everything else, vary in price throughout the year depending on supply. In the winter, raspberry prices might rise up to $5 because there's less supply. And at that price, I usually opt for a different type of fruit. But raspberries are obviously worth $5 to somebody. Otherwise, the grocery store wouldn't price them that way. If raspberry prices fall to $3 in the winter, then I'm probably going to buy. And during those few magical weeks in the summer when raspberries sell for $1 a pint, I stockpile as many as I feel like I can eat before they spoil. When I make my purchase decision, I never really question whether price is accurate. Price is set according to supply and demand. In summer months, when the supply is high, price is low. In the winter months, when supply is low, the price tends to be higher. If raspberries aren't selling and the product is nearing the end of its shelf life, the grocery store marks down prices to entice buyers like myself to purchase them. So in short, the daily price of raspberries varies based on buyer and seller expectations of market forces. People tend to respect the power of supply and demand in markets in their everyday life, but that respect seems to break down when it comes to financial markets. At one point or another, nearly every investor makes the mistake of trying to beat the market. Maybe they buy shares of an individual stock. Maybe they sell a portion of their portfolio in anticipation of a market decline. Maybe they wait to invest cash because they feel the market is overvalued. Maybe they buy actively managed mutual funds that promise to deliver above-average returns or protect against market declines. These are all examples of competing with the market or trying to outsmart the market. Most investors that take this route underestimate the competition within financial markets and overestimate the opportunity for above-average returns. I go on to explain how you're competing against the collective knowledge of financial markets using examples with cows and jelly beans and eventually the stock market. And I can link to a blog post in the show notes called The Collective Knowledge of Financial Markets. They'll cover this topic a bit too. Understanding this concept makes it much more clear why active management typically trails passive management, but also why the general objective of trying to outsmart the market is a loser's game. And the book uses both data and anecdotes to explain why this is the case. And again, I said I don't want to really sit here and go word for word over every chapter, but I will link to several blog posts in the show notes, one of which is called Active versus Passive, The Wrong Debate, and Market Prediction is Harder Than You Think, because these narratives are some of my favorite in the book. And while this chapter is teeing up an investment philosophy, that investment philosophy really helps you as you move on to the next chapter, which really focuses on designing and implementing a portfolio that meets your specific goals. So let's jump right into it. Chapter 7, it's titled Building a Portfolio to Meet Your Goals. I start the process by explaining the trade-offs between risk and return. The primary driver of investment returns is risk. Investing is all about earning a return in exchange for accepting volatility, uncertainty, and the potential for permanent loss. The key is to find the right balance of risk and return by dividing up your investment dollars among stocks, bonds, and cash. This process, known as asset allocation, is the most important decision a long-term investor makes. In fact, the most commonly cited research on the topic determined that asset allocation explains 93.6% of variation in portfolio returns. Your portfolio will always rise and fall with the overall market, but the specific mix of stocks and bonds dictates the range of possible outcomes. Portfolios with a greater percentage of assets allocated to stock have historically earned a higher return. However, those same portfolios with the highest return also experience the most years with a loss and the widest range of possible outcomes. We've talked about this before, but losses are painful to experience as an investor. But trying to completely avoid losses exposes your portfolio to other risks, such as not generating high enough returns to meet your goals. Portfolios that don't take enough risk require an unrealistic savings rate relative to your cash flow, and very few people can simply save enough money in cash to meet all their financial goals. A second risk of avoiding riskier assets like stocks is inflation, which may actually outweigh the risk of short-term market losses. The historical rate of inflation has been 3%, and so if we assumed a flat 3% inflation rate, it would reduce the portfolio's purchasing power by nearly 59% over a 30-year time horizon. A quote I like and I find myself saying fairly often in client interactions is, quote, "The goal of investing is to grow your savings faster than inflation without taking undue risks," end quote. By investing in stocks and bonds, you're providing financial capital to businesses that take that capital to produce goods or services that they can sell for a profit. As providers of financial capital, the investor, which is you, expects a return on your money. Historically, investors earn a higher return for owning stocks than bonds. The higher expected return for stocks is compensation for accepting greater uncertainty and volatility in the price of the investment. Over long periods of time, the difference in returns between stocks and bonds, which we refer to as the equity premium, translates into staggering wealth differentials. But unfortunately, it isn't as easy as saying, I want higher returns, so I'll just own more stocks. Stocks do have higher expected returns, but the day-to-day experience of earning those higher returns is far more stressful than it appears on paper. Ignoring risk and only focusing on return is going to increase the chance that you're going to be in a portfolio that's way more painful than you can tolerate. And that's where bonds come in. When stock markets experience a sharp fall, bonds act as the diversifier and reduce the overall volatility of the portfolio. And this relative lack of volatility is the primary reason to include some percentage of bond exposure in your portfolio. As for cash, it's one thing to have an emergency fund, but having too much cash in your portfolio can be problematic for two reasons. One is that cash provides a really poor long-term return. It's negative, actually, after you subtract out inflation and tax. So cash, really poor for returning asset. The second problem is that holding too much cash creates this psychological mind games. And I see it all the time that people holding a lot of cash in their portfolio, whether it's cash they've built up over time or there's been a big windfall, when stocks are going up, investors in this situation will frequently tell themselves that they're going to wait for a market decline to use their cash to buy more stocks. But then when prices of stocks actually do start to fall, they wait for prices to fall further. And in both cases, you have to overcome the desire to invest at just the right time in order to invest your cash. So fine to keep a nominal amount of cash in the portfolio, but really the trade-off in asset allocation is about the mix of stocks and bonds. And I have some really cool graphics and data on each of the asset classes that's perhaps more focused on the why, but the how to invest really comes into play as we start talking about the appropriate mix of stocks and bonds and cash, which is really an exercise of assessing your ability and willingness to take risk. So I always tell clients that there's no such thing as a perfect portfolio. And I think that's important to keep in mind because assessing risk tolerance is all about finding the best portfolio for you, the one that you can stick with for decades at a time. And risk tolerance is a mix of measuring ability, which is mostly objective. It's a process where you're looking at time horizon, the size of your human capital or your earnings potential, your liquidity needs relative to the size of your portfolio, the flexibility of your goals, etc. Whereas willingness to tolerate risk is more subjective. So I share some exercises in the book that I use with clients to help measure this aspect. I also have a link I can put in the show notes here on assessing risk tolerance. This is arguably one of the more important parts of the chapter because building the perfect portfolio doesn't matter one bit if it doesn't align with your willingness and ability to take risk. The way you divvy up your investments between stocks and bonds is going to set the tone for the expected range of returns and the overall volatility of the portfolio. The more stocks you own, the higher you expect returns and volatility to be. So after I spend some time talking about the appropriate mix of stocks and bonds, I move on to the concept of diversification, which may seem obvious, but many investors believe they're well diversified when in fact they're not. And in the book, I share several examples that I commonly see that are different types of what I'll call false diversification. Diversification has obvious appeal from a risk tolerance standpoint, but the real jaw-dropping aha moment for most people comes when I show how diversification allows the portfolio to compound returns more effectively. And again, in the chapter, I revert back a little bit into theory because understanding the theory makes it easier to stay the course when markets make it very difficult to do so. And most people would argue that they ought to be diversified anyway. So it's not like I'm making a hard case here, but they don't really understand the math behind it. And the math will really blow your mind. The example I show in the book are two portfolios with identical average returns, and I line up the year-by-year returns, and you see that they have different levels of volatility. And as you'll see in that table, the portfolio with lower volatility ends up with more money because of the impact volatility has on compound interest. So at this point in the chapter, we've learned about setting an asset allocation that's aligned with your ability and willingness to take risk. We've talked about properly diversifying within that asset allocation. And then the final piece of this portfolio construction process is how do you maintain these initial portfolio exposures? And that process is rebalancing. Throughout the chapter, the examples make it clear that periods of higher returns in any given market are often followed by periods of lower returns. And rebalancing helps take advantage of this trend by selling asset classes that have done well and buying those that have done poorly. In other words, rebalancing ensures you buy low and sell high. To better understand the benefit of rebalancing, I simply compare a portfolio that's rebalanced once a year versus one that's not. And quick spoiler alert, so I don't have to read you the whole chapter here. Not only did the rebalanced portfolio end up with more money, but the losses during the worst performing periods weren't quite as bad. So there's an added emotional bonus there too. There's no guarantee that rebalancing is going to enhance performance, but the biggest benefit in my mind of rebalancing is that you're going to keep your risk exposure in line with your risk tolerance. So if you set out to invest in a portfolio with 70% stocks because that's what meets your needs, then you don't want to let that portfolio drift to 80% stocks because that's a riskier portfolio than you meant to be in the first place. On to Chapter 8, how and where to invest your savings. With a solid foundation of investment theory in place, Chapter 8 focuses on implementing a systematic approach to investing that will ensure your financial plan fully benefits from the power of compounding. If you've been building a draft financial plan as you're reading through the book, at this stage, you're going to have several things in place. You're going to have goals with an expected value and a completion date. And these goals are also going to be ranked by prioritization, with retirement savings and emergency fund as top priorities. You're also going to have a handle on your current financial situation, including what assets and liabilities you have. You should have a good idea of how much cash flow you have available each month to direct towards your goals. And finally, you should have all your savings, bills, and debt repayments set up to be made automatically. And assuming you've done all this work, it's time to begin dollar cost averaging into your investment accounts. Dollar cost averaging is simply contributing a set amount to your portfolio on a regular schedule over time. And when you automate your dollar cost averaging, you remove the need to determine when is the best time to invest, and that alone helps you avoid a lot of the errors that we ended up highlighting in Chapter 5. Dollar cost averaging is also the simplest way to invest paycheck by paycheck with the planned savings from your reverse budget that we talked about in Chapter 4. You don't really have to do anything beyond setting up the automated monthly contributions. In fact, you're probably already dollar cost averaging if you're using an employer-sponsored retirement plan like a 401k or a 403b, 457, etc. Now, I do address that while dollar cost averaging is the best way to systematically invest your ongoing savings, it doesn't address the common situation of how to invest a large sum of money. Nobody wants to invest at the wrong time, but you have to remember that market timing is a game that nobody can win. At this point in the chapter, when I'm talking about dollar cost averaging, I do call out a situation in which you have to decide how to invest a large amount of cash that's been building up slowly over time or is the result of some sort of windfall. And the probabilities suggest that investing that large sum of cash all at once has the higher expected return, in part because you have a longer time to compound, also because markets tend to be up over time. But for ongoing savings, dollar cost averaging is going to be the best approach. And there's a quote within that discussion I like. Quote, "It's tempting to think about the possibility of buying at just the right moment. But here's a dirty little secret that most of the investment industry doesn't want you to know. Time is more important than timing." End quote. There are several examples in the chapter that show why investment success is more about timing the market than correctly timing market movements. And I also share some case studies to show why focusing on your savings rate rather than your rate of return is going to be a more effective use of your time. And finally, the chapter wraps up by focusing on reducing your tax bill to maximize your investment return and accelerate your progress towards your goals. Because while taxes are an inevitable part of earning money, there are really only a couple different ways to minimize them. So at the end of the chapter, I end up covering IRAs, Roth IRAs, employer-sponsored retirement plans, which are 401ks, 403bs, 457s, simple IRAs, SEP IRAs, etc. You get the point. I also cover the best order to leverage these accounts to save for retirement. I have a link that I can put in the show notes that does the same thing in case you're looking for the quick answer there. And then finally, I wrap up with tax-deferred accounts with a really high-level overview of the EP.05 plans. I actually go deeper on education savings in Chapter 10, so I will save that for that point. Finally, I wrap up the tax-deferred account discussion with a relatively high-level overview of the basics of 529 plans, but I go into that in greater detail in Chapter 10, so I'm going to save that for that point. So finally, now we're at Chapter 9, the final chapter of the investment section. It's called Facing the Realities of Market Downturns. And at this point, you now have everything you need to build a portfolio and invest your savings to meet your goals. The investment plan laid out focuses on things within your control: investment costs, asset allocation, savings rate, and maybe most importantly, your own behavior. Now, you simply must have the discipline to stay the course, no matter what. This is arguably the most challenging part of investing, particularly when markets are falling. So here's the opening paragraph of Chapter 9. Mike Tyson once said, "Everyone has a plan until they get punched in the mouth." Knowing that you're going to get punched in the face, literally or figuratively, isn't fun. But it does allow us to mentally prepare ourselves to make better decisions after taking a right hook from Mr. Market. One of the first things to accept as an investor is that occasionally you're going to lose money, sometimes a lot of it, on the way to earning a decent return. This is part of the risk you bear in exchange of higher expected returns on your investments. The market will take twists and turns throughout your lifetime. In the financial media, they're going to make everything seem way worse along the way, making it even harder to stay calm and rational. And then there's also the internet that's made stock market data and real-time portfolio values increasingly easy to access, which is problematic because it causes investors to lose sight of the big picture. We already know that loss aversion makes losses hurt about twice as much as similar-sized gains make us feel good. The result is that investors tend to make poor decisions as a consequence of trying to avoid the pain of a relative or absolute loss. I find that the more prepared someone is for losses, the less likely they're to succumb to the bad decisions associated with trying to avoid it. We never know when and why the next downturn is going to happen, but we do know that market downturns happen on a regular basis. And there's a graph in the book that shows the worst drawdowns for the S&P 500 every year dating back to 1926. And we see that there are double-digit losses occurring in 65% of calendar years, and nearly a quarter of the time, those losses are greater than 20%. But despite the frequent losses, we see that the S&P 500 earned an average annual return just over 10% for this period. Another stat that I share frequently with clients is that the S&P 500 has historically had a 10% decline about once every 12 months, a 20% decline about once every 3.5 years, and a 30% or greater decline about once a decade. Remember, risk and return are very closely related. Losses are the price you pay in exchange for the higher expected returns. There's no such thing as a riskless high return investment, and if anybody tells you that, you should run away as fast as you can. But the good news is that you can reduce some of the chance of permanent loss by staying invested over a long period of time. In fact, market losses can present huge advantages to investors who are dollar cost averaging because market downturns allow you to buy stocks at lower prices. And I share several graphics to drive this point home, really just to familiarize readers with the normalcy of losses. And these charts are a good instance where a picture is well worth more than 1,000 words. It's a picture-heavy chapter, and I really can't possibly do it justice by voice, but I can link to a page on the show notes. It's called viewthecharts.com. You can see every chart from the book. So as I've been going through this, you can probably follow along and try to get a little sense of what it is I'm talking about graphically. But I think the primary takeaway from the chapter can be summed up with this passage. Quote, "Volatility is not the enemy. It's only the cost of higher returns in the long run. When you accept that the market is very good at incorporating information into prices, you'll see there's no way for people to reasonably predict when and why downturns occur. But we can reasonably expect downturns to continue occurring with a similar degree of frequency in the future. That means we can plan for them, and you're better off planning on downturns occurring regularly than trying to predict when stocks will take a tumble." End quote. In the next episode, I'll cover the final 3 chapters of the book that are focused on big decisions you only make once or maybe a couple times, but that have giant financial ramifications, so it's important to get these decisions right. For show notes, free resources, and a place to submit questions, please visit thelongterminvestor.com. If you enjoy the show, you can subscribe wherever you listen to podcasts, and please leave me a review. I read every single one, and I appreciate you taking the time to let me know what you think. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.